So it's been a little more than a week now after the last Fed rate cut, and what's actually happening is we are seeing interest rates on 30-year mortgages continue to rise, which is exactly the opposite of what everybody thought was going to happen. And you know what, guys? I actually kind of love that this is happening just because it proves that what me and others here on YouTube have been saying about the economy is actually true. Because if it wasn't and everything was great, like we keep being told that it is, then the interest rates on these 30-year mortgages would likely be continuing to fall, but in fact they are rising. So why is this happening? Well, it's because the mortgage market follows the 10-year treasury market almost to a T, all right? And if you take a look at what's happening right now with 10-year treasuries, ever since the Fed rate cut, it has gone nowhere but up. The Fed cut rates back on September 18th, and as of me filming this, it's September 26th. And what do you see is the 10-year treasury has been going nowhere but up. On September 18th, the 10-year treasury note was sitting at 3.74%. Now today it's sitting at 3.794%. So it's not a massive increase, but it's definitely not going down. Okay, which was the expected result. Everybody was expecting that interest rates on all of these different types of loans would be falling after the Fed rate cut. And if we take a look at what's happening right now with 30-year mortgages, we're seeing the exact same thing since the mortgage market tracks the treasury market. On the day of the Fed rate cut on September 18th, you could get a 30-year mortgage for 6.15%. And fast forward to today, you can get a 30-year mortgage for 6.21%. Once again, not a massive increase, but these mortgage rates have gone nowhere but up. And here's something to think about for everybody out there who has been so bullish on the economy, thinking that things were going to go up forever. You know, if mortgage rates have already come down by 2 percentage points since a year ago, because last October, a 30-year mortgage would cost you almost 8% interest, and that was for good credit. And that did not bring people back into the market, having these mortgage rates fall by 2 percentage points, which everyone thought that it would make a meaningful difference by now, but it hasn't. And what kind of effect do you think this is going to have on the real estate market once the interest rates continue to go back up? Okay, that's what we're seeing right now. You think demand is bad now? Just wait until interest rates continue to go up, guys. And I'm not predicting that they will continue to go up, but the bond market is actually who's predicting that they're going to go up, because they are now demanding higher yields for these 10-year treasuries than they did before the rate cut. Probably because they do not trust what the Fed is saying on inflation. All of this sweet talk about inflation being behind us and the worst of it is over and blah, 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 you know, they're not having it. You know, people who invest in these treasuries are saying, no, we want more money because we think inflation is going to continue to be a problem. And as that happens, the mortgage rates go up, the car loan rates go up, which is going to continue to hinder demand in the housing market. Now, I'm not guaranteeing that mortgage rates will continue to go up, but for now they are. And I think it's going to depend largely on the future jobs and inflation data that we get and where these treasury markets move from there. Because all the predictions have been saying that the jobs reports are going to continue to get worse throughout the year. Some people are saying we're going to keep seeing more deflation in the economy and that's not going to be an issue anymore. Other people are saying that, you know, inflation is starting to bounce back, especially when you look at the core inflation numbers, which is something that the Fed looks at. So I don't know what's going to happen, guys. I'm not an expert. I just report to you on what I see and the things that are actually happening. But what I do know is this is not the result that a lot of people were expecting after the first Fed rate cut. And I guess it will be interesting to see if they continue chopping rates throughout the rest of the year, what's going to happen with mortgage rates. Will they follow or will they continue to go up? Because if they continue to go up, the Fed is going to have a real mess on their hands, and I don't really know what they're going to be able to do to fix it. Probably nothing is my guess. And just like the Fed, the federal government is doing everything it can to try and patch together this weak economy and this weak housing market we have. Jonathan sent me this new proposal from the USDA, which applies to federal government-backed loans for housing. And basically what they're trying to do is make it easier here for people to borrow money who defaulted on a government loan before. They also want to make it easier for these people to refinance their homes now that supposedly interest rates are going down, right? Well, on a 1-year basis, yeah, the interest rates are going down. So if somebody, let's say, got a USDA loan a year ago at 7.8% and now they could get one at 6%, then yeah, it's probably worth refinancing for them. And what they're trying to do is keep people in their homes. They're trying to give people the easiest access to credit and financing as possible, even if they don't have the greatest track record of making payments on time. So even in 2024, guys, the shenanigans are not over, okay? The government is still trying to do different things to help people out in terms of making their housing payments affordable, okay? First it was you don't have to pay at all. Then it was now you have to start paying again, but it can be at a reduced amount because, you know, we can get you a special deal with your loan servicer and stretch out your loan essentially for more years and make your payment lower. Now it's, oh, even if you defaulted in the past, you couldn't make payments. Now we're looking at being able to extend more credit to people like that. Like, it just never ends. And listen, I recognize that some people do need financial help from time to time, but the reality is the government continues to offer all this help because it's an election year. You know, once all this is over, there's a good chance that a lot of this help is going to go away because the political motivations for keeping the magic show on the road won't really be there anymore. Although the government still does have a strong motivation to keep people in their homes after the election, just from the standpoint that they own so many mortgage-backed securities. And if more and more people continue to default on their mortgage, that's not going to be good for them. Here we have a house for sale practically at $3.2 million. They just listed it about a week ago, and they bought it during the last housing crash at $1.6 million, probably right before the market tanked. So they kind of probably paid a lot for it at the time. And who knows, maybe they'll get it because Redfin says this is right on par with what this house should go for, even with a comp in the neighborhood selling at $3.2 million. Maybe they'll get lucky, maybe not. But I want you to pay attention to this part right here. Back in 2008, the previous owner had a property tax bill of only $700 a year. How is that possible? They had an assessed value of $1.5 million. But notice once the new owner took possession, the property taxes went up to $18,000 a year and are now currently $30,000 a year. This is going to be super important. As I get into the next part of the video, I'm going to explain how and why inventory in California still remains relatively low compared to other states, and even though home prices are dropping in many areas, they remain still pretty high compared to a lot of other places. Now, speaking of home prices here in California, I want to go over something that I never really realized before, but it's now starting to make sense. Like, obviously, California is probably the most expensive state in the country to buy any sort of house or real estate. Okay, that's not really a secret. And part of the reason that's the case is because back in 1978, California passed Proposition 13, which is designed to keep property tax bills in check as the value of their homes increase. And looking backwards, that was actually a really great measure that California passed to protect its homeowners here, because I've shown you guys in a recent video that I did with Mitch Vexler and also other videos I've done on my own how much of a scam property taxes are. And you know, California catches a lot of flack for doing a lot of terrible things politically and legally speaking. But this was probably one of the best things they ever did in order to protect its citizens from being priced out of their home as they get older, as you own a home for many years. So what Proposition 13 is it essentially caps how much your property taxes can go up. So it caps the tax amount at 1% of the assessed value of the home. Okay, the taxes cannot be higher than that. And it also caps your annual increase at 2% per year maximum. Okay, and it could be even less than that depending on what's happening with inflation. So I'm sure recently everybody has seen that maximum 2% increase, but still 2% isn't so bad compared to what a lot of other people see in other states. You know, many people have written me saying, hey, my property tax bill just got reassessed and it went up 20 or 30% in 1 year. You know, that could be a decade or more worth of increases here in California if you own real estate here. Now, the people who are against this say that this is part of the reason that California has such a housing crisis and a housing shortage, because it encourages people to hang on to their homes for a very long time, which is actually a good thing, right? I mean, do you think it's better that people get priced out of their home as they age just because the house becomes more valuable? You know, if you bought the house 30 years ago for 80 grand and now it's worth 3 million like this one down the street, you know, is it really fair that you have to be priced out of your home just because the real estate market went berserk around you? And in reality, it's all just due to inflation and government money printing. But something else was brought to my attention recently from one of my viewers here in California, and this can also explain why there's always so few homes here for sale compared to other places, and why it's harder to see like a housing crash type of situation here. And what it is California also has Proposition 58 and Proposition 193. And what these two constitutional amendments allow people to do is transfer their house from one generation to the next without seeing the value get reassessed. It also allows people to transfer their house from one generation and skip a generation. Like, say if you have your grandparents that own a house here and your parents are deceased, they can then transfer it to their grandchildren and also not see the value of that property reassessed during this transfer. So these are two extremely powerful tools to keep the current housing supply in the family, so to speak. Okay, this is a way to pass down real estate from generation to generation without seeing a massive increase in your property tax bill. And as far as I know, I don't know anywhere else that actually does this. I'm not sure if any other states have laws like this. And so obviously that does make it so that housing is artificially withheld and people don't sell, because it makes a lot more sense if you're somebody who bought a house 30 years ago and you have children to pass it down to them, and they can essentially inherit this house without having to see their property tax bill shoot up tremendously. The problem is, say if you are somebody today who just moved to the state, or your family never had enough money to buy a house in the past and pass it on to you, then you're looking at paying today's prices and getting locked in at today's property taxes, which is unaffordable for the vast majority of people. I would be willing to bet that a lot of people that can buy these really expensive homes around here are able to do so because their housing cost has been essentially subsidized for so many years. I mean, if you bought a house 30 years ago for 80 grand and paid it off, say 15 years ago, have had no mortgage, been able to keep those property taxes artificially low, and can earn a high California income, you're able to amass an extreme amount of wealth over the past 15, 20, or 30 years. And it's probably pretty easy to buy a house that costs $2 or $3 million now, or help your children or someone else in your family to buy these homes. So I want to bring this up because obviously I'm here in California right now, and a lot of people think that the reason California housing is so expensive is just because they don't build a lot of housing here anymore, and because so many people want to live here. But it's actually because of the tax incentives to hang on to the real estate here and pass it down from generation to generation that makes it so that so few people actually ever want or need to sell their home. And that goes for your primary residence, but even if you own an investment property, for example, and you want to pass that down to your children, just the first $1 million of the value of that property is also exempt from getting assessed at a higher value. So even though that investment property will see a higher assessment once passed down, it's not going to be as high as it would be if those people were just buying that property, you know, directly from one owner to the next right now. But I wanted to bring this up because California gets such a bad rap, and deservingly so, in so many other areas of law. But this is probably the one thing that they did that really has helped a lot of people here not only amass a tremendous amount of wealth, but also help elderly people from being priced out of their home, which in the end of the day is probably a good thing. Now, one of my viewers wrote me an email who's having a lot of trouble right now financially, and trouble with a house that they purchased pretty much during the peak of the housing market. They kind of did all the things that I've been telling people not to do over the past couple of years, and unfortunately now they are starting to feel the consequences from this. And I want to bring up a few key points and mistakes that they made to give people an idea of what we need to avoid, guys, because they could have easily avoided this situation if they would have just listened to a few things that I said. And unfortunately now they're in a position where they're kind of forced to sell their house and probably even take a loss or maybe do a short sale on the property. So what they did is they bought a new construction property kind of in the middle of nowhere, and according to what they told me, the road is not even paved yet. Like, it's still a dirt road, so it's not really an established development, to say the least. So they're kind of missing living in the city where they used to live and living more close to civilization, kind of like where I'm walking through here, in a more established area, right? And besides that, they've also had a lot of financial problems with the house in terms of repairs. Okay, they had to put in a brand new water heater. They didn't say how much they paid for that, but they had to finance a new shower. That cost them $18,000. Then they had to put in a new water softener. That cost another $8,000. So when you add just those repairs up alone over the past couple of years, they've already had to spend $30,000 repairing this house that they just bought a couple of years ago, guys. That is a lot, okay? If you're a renter, you are not ever gonna have to do that. You're never gonna have to pay an additional $30,000 on top of your rent for some things that might go wrong at your rental. And they've also been unlucky enough to experience a tremendous increase in their homeowners insurance because they live in a highly fire-prone area. And here in California, that's a big problem. And people are losing insurance over that, just like people who live in, major flood zones like in Florida, and no one will cover them. So they just lost their homeowners insurance. Their old policy was $1,600 a year. Now they're looking at a new policy of over $3,300 a year. And that was the lowest one that they could find. Okay, and according to the California Fair Plan, which is kind of like the insurance of last resort, just like Florida's Citizens Insurance, the California Fair Plan would cost over $4,000 a year, and that's without any liability. So you add on the liability insurance, and now they're looking at $8,000 a year in homeowners insurance, going up from only $1,600 a year, guys. I don't know what multiple of increase that is, but that's probably at least 4 to 5 times more expensive, if not more. So the problem is so many people did this, right? So many people purchased during this volatile season of the housing market when prices were seemingly going nowhere but up and everybody thought that it was just never going to end. And these are all things that I told people would happen during this time, that prices are going to settle down and the expenses to repair houses are going through the roof right now, and these things are going to cost you a fortune. If you don't have the extra money, it can bankrupt you. I said all that, I don't know how many times, countless times on the channel. And to top it all off, they bought this house and they're looking at selling it now. They have it on the market and they're not able to sell the house, and they're looking at selling the house potentially now for a loss in order to just get rid of it and move back into civilization and being a renter again. So they went through all of this hassle to be a homeowner. It didn't work out so well, and then they're going to be back to square one as a renter and lose all of the money that they invested into the house, the down payment, all of the money made towards the principal payments of the house and interest, of course, as well as all of the repair costs they had along the way. All that money is just wasted and gone forever, guys. So many people have said over the years, oh, it's such a waste of money to be a renter. You're just making your landlord rich and you get nothing in the end. Well, what happens if you go through a scenario like this? Who are you really hurting then? You're hurting your own finances far more than helping someone else's if you're going to be a renter. And I'm not bringing up this story to bash this couple for doing this. Obviously, they made a bad decision and they're going to have to now live with their mistake and figure out what's going to be the next best course of action for them. But I bring it up as an example to show people what can happen when you buy at the wrong time. Okay, because there's that old saying that, it's a fool's errand to time the market. You can never time the market exactly when it comes to buying real estate. You can never know exactly when the market is at its peak or at the bottom, but you can pay attention to the trends like we've been doing here on the channel since all of this madness started, and recognize that, yeah, this probably isn't the best time to buy. Let's wait this out, because historically speaking, whatever's happening is not normal, and it probably will normalize eventually. And when it does, that's when you go ahead and pull the trigger. But instead, people just ignored that and said, I know better, or I'm just desperate to get the house now, or my realtor told me if I don't buy now, I'm never going to be able to, and fell for that stuff and made a really bad financial decision for themselves and their family. And listen, on the contrary, other people made the same decision and it worked out really well. You know, it depends on where you bought and which market you purchased in. Other people who bought during the same time frame did really well. In fact, I'm one of them. But the reason that I was able to do that is because of my history and experience with real estate, knowing my local market and knowing what's a good deal and what wasn't, and the true value of a property, guys. Like, that's what it comes down to. And most people who've never bought a house before just don't have that experience and knowledge and are now suffering because of it. I'm not saying I'm the smartest person ever, guys, or I only make all the right decisions in life, but I sold real estate full time for 13 years and I stayed exclusive to the Miami Beach market. And so when a deal came up that I knew was going to be a deal of a lifetime, I grabbed it. I didn't care that it was, you know, the end of 2021 or the beginning of 2022. None of that matters. All that matters is the price that you pay. Okay, it doesn't matter when you buy, it matters the price that you pay. Other people who bought during the peak of the housing market probably got tremendous deals depending on where they purchased a property and for how much. So this can go both ways at any time. But right now, it's extremely clear that almost all markets across the country are seeing some level of a downturn, whether it's severe like downtown San Francisco or Manhattan and New York City that are seeing, you know, 20, 30, 40% declines in prices from 5 years ago. That's significant. You know, that's a major housing crash. Other places have only seen it just now start to dip. Even in Miami, where I live, is one of them. Prices are finally starting to come down a little bit there. Even here, I've shown you guys multiple examples of different neighborhoods I've walked through here, different condos, different townhouses, different houses for sale that people are today selling for less than they paid for it 2 years ago. So there's many examples out there of people doing this. And I just hope that anybody who's buying today doesn't become the next person in line for that mess, okay? Because you can buy today and still do well. I'm not saying that's impossible, but the odds of it right now are way less likely because of the direction of the market right now. So just keep that in mind if you're somebody looking to buy today. And remember, if you are somebody looking to buy or sell today, I offer free real estate services for you guys. It costs you nothing. You can always use the link down in the description of my videos, and I can set you up with a real estate agent anywhere across the country completely for free. Now, one thing I mentioned the other day is the electric car industry here in the United States is subsidized by the federal government, and also they had similar subsidies in Germany, and now that those subsidies are gone, the electric car sales are absolutely tanking, right? Well, just like I talked about earlier about the government trying to help people stay in their homes that don't have the best financial track record, we continue to see more and more stories of both federal and private subsidies going into the electric car market. Monroe Capital LLC, which is an investment firm, just said that they were going to spend $1 billion to provide loans for smaller auto suppliers as the industry shifts from gasoline-powered to electric vehicles. And of course, this $1 billion that they plan to spend is also going to be backed by the federal government through the Small Business Administration in order to give out this money in the form of low-cost loans. So once again, we're seeing something being subsidized by both private and government-backed funding right now of something that people don't want to buy, guys. Yeah, sure, there's a lot of people out there who buy these cars, but the vast majority of people still don't buy them. The only affordable way that they've come up with to try and get people to buy these cars is to essentially give them away, to artificially lower the price of them. And just like we saw already what happened with Germany, once those subsidies are no longer available, once they're no longer pumping money into this to help people buy these cars on the cheap, well, what's going to happen then? Probably the same thing that Germany saw happen. They're going to see the demand for these cars fall through the floor. Now, I wasn't around back when they invented the gasoline vehicle, obviously, and most people who watch this channel probably weren't either. So if you know the history on this, feel free to comment on it. But I'm pretty sure back then they didn't have to essentially give away gasoline-powered vehicles in order to get people to drive them. I think they were probably highly desirable and very expensive from the get-go because it was such a leap forward from driving the horse and buggy. We know that Henry Ford invented the assembly line to produce cars cars for a much lower price than other manufacturers, and probably through this invention was able to lower the price of these cars enough to actually get them to sell, not through hundreds of different government-backed initiatives and subsidies to convince people to buy one. Correct me if I'm wrong, guys. I'm just taking a shot at it. I'm guessing. I don't know. But anyways, if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.